Donald Trump has promised, once again, to stabilize the economy. There is little reason to doubt his intent. He understands debt, leverage, and negotiation. But intent is irrelevant when the problem is structural. What is forming beneath the surface of the United States economy is not the result of one administration, one party, or one policy mistake. It is the outcome of decades of accumulated decisions that obey mathematics, not politics. The forces now converging were set in motion long before the current election cycle. And once systems reach this stage, leadership no longer determines the outcome. Time 0.5s. The only remaining question is how the process unfolds. The first constraint is debt, and it is no longer abstract. The national balance sheet has reached a scale where traditional policy tools lose relevance. Total federal debt now exceeds annual economic output, and it continues to grow by trillions each year, regardless of who occupies the White House. This growth is not tied to a single presidency. It is the cumulative result of decades of deficit financing layered on top of one another. What makes this stage different is interest. Servicing existing obligations now consumes more than $1 trillion annually. That figure represents cost, not repayment. When interest alone rivals or exceeds spending on defense and approaches the scale of core entitlement programs, flexibility disappears. Revenue becomes pre-committed before new decisions can even be debated. At that point, reducing deficits requires cuts to programs that form the political foundation of the system itself. Social support, healthcare for retirees, and military spending are not discretionary in practice. As debt expands, interest grows alongside it, tightening the budget further. The process reinforces itself. Once this cycle is established, leadership can slow nothing without triggering consequences that the system is structurally designed to resist. The second constraint lies with monetary policy, where control is often assumed but rarely examined. The Federal Reserve is presented as independent, yet independence offers no escape when both available paths lead to contraction. Interest rates cannot be adjusted freely once debt reaches this scale. Each movement carries systemic consequences that compound existing fragility. Raising rates restrains inflation, but it simultaneously increases borrowing costs across the entire economy. Mortgages, corporate loans, and government refinancing all become more expensive at once. Asset values adjust downward, credit tightens, and unemployment rises. The result is not stabilization, but rapid deceleration. Lowering rates avoids that immediate shock, yet it accelerates a different failure by allowing inflation to erode purchasing power and currency confidence. This is not a policy debate. It is a structural trap created by prolonged reliance on cheap credit and monetary expansion. The longer rates were suppressed, the narrower the exit became. At this stage, even perfect coordination between fiscal authorities and the central bank would not restore balance. Any decision simply shifts stress from one part of the system to another. Once monetary policy reaches this condition, leadership loses the ability to choose outcomes. It can only choose the order in which pressures surface. The third constraint is demographic, and unlike policy or markets, it cannot be adjusted on a timetable. Population structure moves slowly, but once it reaches an inflection point, its effects become unavoidable. A large generation is exiting the workforce while drawing on systems that were designed for a very different ratio of contributors to beneficiaries. Every day, thousands of people transition into retirement, bringing with them guaranteed claims on pensions and healthcare. At the same time, the working population supporting those commitments is proportionally smaller than in any previous period of modern economic history. This imbalance did not appear suddenly. It developed over decades of declining birth rates and rising life expectancy. No legislation can reverse this trend within the time frame that matters. Workers cannot be created instantly, and productivity gains cannot fully offset the scale of the shift. Even aggressive immigration policies would require years before fiscal contributions materialize. By the time the pressure becomes visible in budgets and trust funds, the underlying cause has already passed the point of correction. Demographics do not negotiate. They only arrive. The fourth constraint operates beyond national borders, where monetary authority ends. The global role of the dollar has long allowed domestic imbalances to persist without immediate consequence. Reserve currency status created sustained external demand for United States debt and enabled deficits that would be unsustainable for any other economy. That arrangement, however, depends on continued trust and participation. Over time, that trust has been weakened by financial weaponization, sanctions policy, and the expansion of alternative settlement systems. Major economies have begun reducing their reliance on the dollar by trading in local currencies, accumulating reserves outside the existing framework, and constructing parallel payment infrastructure. These shifts are incremental, but they are directional. Once diversification begins at scale, it rarely reverses. No administration can compel foreign governments to maintain exposure to a system they view as a liability. Reserve status erodes gradually, then abruptly, as confidence breaks. At that point, external financing becomes conditional, costs rise, and domestic policy space contracts. This process does not require coordination or confrontation. It advances quietly, driven by rational self-interest across the global system. The fifth constraint is already materializing within the financial system itself, where valuation assumptions no longer align with reality. Commercial real estate, once treated as a stable source of income and collateral, has entered a structural decline driven by changes that cannot be reversed through stimulus or policy adjustments. Remote work reduced demand for office space. Digital commerce hollowed out retail footprints. Occupancy fell while financing conditions tightened. At the same time, a large volume of debt tied to these properties is approaching maturity. These loans were issued under assumptions of near zero interest rates and full utilization. Those conditions no longer exist. Refinancing now requires higher rates applied to assets worth substantially less than before. In many cases, the numbers no longer close. When defaults occur, losses move directly onto the balance sheets of regional lenders that concentrated exposure in these markets. The issue is not isolated to individual buildings, but embedded in the credit system supporting them. Delaying recognition through temporary support only extends the imbalance. Eventually, asset values must reset and losses must be absorbed. When that process begins, liquidity contracts, confidence weakens, and stress propagates outward through the financial network. The sixth constraint sits at the core of the system and connects all others: persistent monetary expansion. Federal spending now exceeds revenue by a margin that cannot be closed through normal adjustment. Each year, the gap is measured in trillions, and it must be financed. When borrowing alone is insufficient or too costly, the remaining mechanism is currency creation through central bank intervention. This process is often framed in technical language, but its function is straightforward. New money is introduced to absorb government debt and sustain spending commitments that cannot be reduced without systemic disruption. Over time, this expansion weakens purchasing power and transfers pressure from balance sheets to households through higher prices. Stopping the process would require either immediate spending cuts on a massive scale or sharp tax increases capable of suppressing economic activity. Both options carry consequences that the political system is structured to avoid. As a result, monetary expansion becomes the default response regardless of administration. Once reliance on this mechanism is established, it perpetuates itself. Each round reduces the margin for reversal, locking the system into a path where stabilization depends on continued erosion rather than correction. The seventh constraint exists largely outside public view, embedded in the architecture of modern finance. The global derivatives market has grown to a scale that dwarfs the real economy it is meant to support. These instruments are designed to distribute risk, but at extreme size they concentrate it instead, binding institutions together through layers of mutual exposure. Derivatives rely on assumptions about interest rates, currency stability, and asset prices remaining within predictable ranges. When those assumptions hold, the system appears stable. When they fail, losses do not remain isolated. They cascade through counterparties that may have no direct connection to the original trigger. This dynamic was exposed during the financial crisis of 2008, when failures spread far beyond the housing market that initiated them. Today, the market is larger, more interconnected, and more sensitive to shifts in rates and currency confidence. As pressures build elsewhere in the system, these contracts amplify stress rather than absorb it. No executive authority governs this network in its entirety. Once disruption begins, it propagates according to contractual obligation, not political intent. The final constraint is intangible, yet decisive. It is trust, and once damaged, it rarely returns on command. The credibility of a monetary system depends not only on balance sheets and policy tools, but on collective belief that commitments will be honored without dilution or manipulation. That belief has been weakening steadily. Global participants observe expanding deficits, repeated monetary interventions, and increasing political polarization. They see currency used as a strategic instrument rather than a neutral medium. Each action, taken in isolation, appears manageable. Together, time 0.3s. They alter perception. When confidence erodes, diversification becomes rational rather than ideological. This process unfolds quietly. Capital reallocates before headlines appear. Systems adjust before crises are acknowledged. By the time trust becomes a public concern, the decisive shift has already occurred. Restoring credibility would require restraint, sacrifice, and long-term consistency across institutions that operate on short horizons. In systems built on confidence, loss is gradual until it is sudden. At that point, stability cannot be argued back into existence. When these constraints are viewed individually, each appears manageable. Debt can be refinanced. Rates can be adjusted. Demographics can be debated. Markets can be supported. Confidence can be reinforced through rhetoric. But systems do not fail in isolation. They fail when pressures converge and reinforce one another faster than they can be absorbed. What defines this stage is not any single decision or actor, but accumulation. Decades of incentives favored expansion over restraint, leverage over resilience, and short-term stability over long-term balance. Those choices produced growth, but they also narrowed the range of possible exits. At a certain scale, systems stop responding to leadership and begin responding only to structure. This is why outcomes become increasingly detached from elections, policies, or intentions. The process does not accelerate because someone chooses it. It accelerates because the underlying mechanisms no longer allow reversal without disruption greater than the system can tolerate. When that threshold is crossed, events unfold according to arithmetic and behavior, not authority. What follows from this understanding is not instruction, but clarity. When systems reach this stage, responsibility quietly shifts away from institutions and toward individuals. Not because individuals caused the outcome, but because large structures no longer adapt quickly enough to shield everyone within them. This has been the pattern in every major monetary transition observed in history. Political narratives will continue to compete for blame. Leaders will promise control, reassurance, and recovery. Short-term measures will be introduced to soften visible stress and preserve confidence. Some will provide temporary relief. Others will amplify longer-term pressure. None will reverse the underlying direction once momentum is established. Periods like this reward neither optimism nor despair. They reward awareness. Those who understand that systemic change unfolds slowly, then all at once, avoid being surprised by outcomes that appear sudden, but were years in the making. History shows that collapse is rarely announced. It is recognized only in retrospect, after adjustment has already begun. This is not a prediction. It is an observation of how complex systems behave when constraints align and flexibility disappears.